Hi, I'm Peter Rose, founder of Longwood Currency Trading. An interesting quote that George Soros said is that when you know you're right, no bet is too big. The question is, when do you know that you're right? That's the tough one. In solving any problem, and trading the Forex market is a problem, and I've discussed that extensively in my videos, talking about the life cycle of a currency position, entry analysis, position management, and exit methodology. And saying that each one of those phases of the life cycle of a currency position is an abstraction from the more complex problem that you're trying to solve in trading currencies. And each one of those problems has one rule, and each rule is composed of sequential conditions that must be met before the rule can be executed. Part of the solution set of solving any problem is knowing what the problem is. You got to know how to solve it. But what nobody talks about is when do you solve that problem? When do you take the action? It's not enough to say, when the short MA crosses the long MA, I'm going to bounce in on a long. That's not a when, that's a system. So you first have to differentiate the definition of when as it's applied to trading and not to some system that's triggering some event that you go. Systems are not, they're not duplicatable, and they're not extensible over the long term. I wrote my rules for the life cycle of a currency position back in, I think it was 2018, 2019. This is June of 2025. And I haven't changed those rules because the conditions, I was a software engineer for 33 years, writing complex business applications. And this is how you write a rule. You write it so that the input that you give it is checked for validity to start with, or it's not acted on. And so you can vary the type of volume. Let's say you're writing a rule to bake a steak in the oven. Part of that rule is to turn the oven up. And one of the conditions is when the oven gets to that temperature, then you're ready to cook that steak. Well, isn't the heat of the oven going to be a function of the thickness of the steak that you're trying to cook? It is. And so you've got two parameters going in. One, which is going to be a static scale. If my steak is 1 inch, I'm going to need to have this temperature for this time. If my steak is this whatever, then I'm going to have these temperatures. So you're not going to be inputting the temperature as a parameter to the rule. You're going to be inputting the thickness of the steak into that rule. So when that steak is 2 inches thick, I'm going to set my oven to this. That's what the rule is going to tell me. So that when becomes the variable that the rule then has the intelligence to resolve. So when do you know you're right? Well, that's the crux of trading itself. How do you trade? How do you analyze order flow, the proximity of economic news releases like an FP or housing starts, or whichever ones you feel are the critical ones that you want to be aware of when you're trading. That's not trading fundamentals. That's just trading news. It's like a stoplight. When the stoplight turns red, that's news. That's an indicator. That's not a fundamental event. Oh, man. In any event, in Soros saying, when you know you're right, no bet is too big. So what's the input to that rule? Is it going to be the size of the bet? Or is it going to be that whatever that condition is when you know you're right? And then the rule will determine the size of the bet. That's the way it should go. So the primary driver to our trading in Forex is knowing when to do something. Any dumbass out there in video land can teach you what to do and how to do it. That's just not sufficient. I have a bachelor's degree in physics, almost a minor in math. I was a software engineer for 33 years. I did real estate investment for 40 years. I didn't just fall off the back of the truck, get lucky, and make $1 million. I had to have a plan. I had to know how to solve problems. I had to know what's important in solving rules. What, how, and when. And if you lack the when, your rule is invalid. So when Soros is saying when you're right, he's being cheeky because he's not really saying when you're right. He knows when he's right. Why does he know that he's right? Because he does the research and the study, and he has trimmed all that stuff down to know what specifically to look at. And he has the experience in knowing, well, if this is what I've got to solve, this is how I got to do it. So that question of when comes into play, and that when becomes more of an experiential process than one that you can write down and say something stupid like when the short MA crosses the long MA, or the fucking Bollinger price hits the Bollinger Band at the upper wing, or the RSI is 80, and those are not wins. And unfortunately, educational system out there only deals with the what and the how, and then clouds over the when with this superficial, when price hits the fib, you get out of the trade. It's crazy, because that's the most important thing. I think that if you lose a lot of times as you go through and you don't know what you're doing, and you finally stumble your way to success, then the question becomes, can you work your way back through the mistakes in order to find out what you did wrong? And the answer to that is 99% no, the person can't, because they don't have the education or the training to do that. Because if you had the training and the education to do that, you wouldn't suffer planet-killing trades to learn your craft. If you're trying to learn how to swim, and you just jump in the pool and almost drown and bob up and down, and you do that over a course of a period of a few weeks, enough times, you'll finally figure out how to when to hold your breath, and when to bounce off the bottom of the pool, and when to flatten out and learn how to float and learn how to swim. But if you were going to teach somebody how to swim, you'd be teaching them the crawl or the backstroke. You wouldn't be teaching them to swim, the principle of the body in relationship to the water, which a really good coach will do. Because the density of the water and your skin resistance and all that stuff will affect your ability to move quickly through the water. When we're trading, there's all this information that's out there. How much of that information do you need in order to learn how to be a successful trader? Well, if you try to learn all that information, which is what 90% of the educational people that are out there are teaching you to do, here's a glossary of 300 terms. Learn this, and oh, by the way, here's how to stage, and here's how to compound, and here's what an RSI can do, and here's the zones, and let's learn a little bit about fundamental analysis and the macroeconomics of the currency market of the two pair countries that we're dealing with, and when their currency is impeded by a lack of inflationary pressure against real assets. What does that do for the economy of the country? I mean, do you have to know how to do that in order to take a 50-50 jump ball bet as to whether, after you place the trade, whether that price is going to go up or whether it's going to go down? It's a coin flip. However, will the price go up more ticks than it does down ticks? There's a statistical probability there. And because of my degree in physics, I've got enough knowledge about the equations of motions in a fluid, equations of motions of a particle in a fluid, and what the probability is that that particular individual particle will move in a certain direction. You can calculate that. It's called Brownian motion. Now, do you need to solve the equations of Brownian motion in order to understand that how a particle would move or what a leaf is going to do if it's coming down a stream and there's a rock in the way? You can do that through observation. You don't need to kill yourself learning 4 years of advanced math to do Brownian motion differential equations. You don't need to do that. And in trading, there's a lot of information that you don't need to know. 99% of what you're being flooded with is unnecessary. I have a fast track program. It runs for 6 weeks. And it basically teaches 5 major terms, with each one of those terms having, three or 4 components to it. You know, like you can have a price is a term you got to understand. Price action is a term you got to understand. And price action goes up or it goes down. Therefore, you can buy price or you can sell price. So you need to know 3 or 4 other definitions about price action in order to say, oh, okay, I got a pretty good idea what price action is. So if I have 20, I don't have 20 terms, they're more like 7 or 8. But if each one of those had 3 subparts to it, or 5 subparts to it, if I had 7 things, I got 5, I got 35 pieces of information that I may need to know in order to hit bid ask on a trading platform, but not the other 400 terms. And because in the fast track program, we organize those terms sequentially, so you're being presented with material that you need to know right now. And then after you hit bid ask, then you need to know what a stop limit is and a profit take profit limit. So we start learning about terms like that. We need to start learning about moving averages and how they demonstrate past price action, which has a probability component of it as to what price action will be in the future based on maybe what the 50 or 200 period moving average is going to be doing. These are all very simple concepts to understand if you understand the node concept. So when we're looking at when we need to do something, it isn't when the Bollinger Band does this and the and the confluence of all these indicators. The problem with that, and I've said this in other videos, and I don't want to kill it, as I call it, a permutation matrix of terror. If I have 2 indicators that I'm looking at, I have 4 different decisions as to how to implement those indicators. There are 4 permutations. If I have indicator A and indicator B, I can use A alone, I can use B alone, I can combine A and then B, and then I can combine B and then A. If I have 3 indicators, that bumps it up to 15 or 19 different permutations. I'm unsure of that. I keep forgetting it because the critical one is 5. And there's 325 different permutations you can arrange 5 different objects in. So you can see that if you have a lot of information and you're new to the game, and somebody says, well, when this happens, and when this happens, and when that happens, that you have 325, 15, maybe 60 different permutations you can put that information in, depending on how many. I think there's 64 or something like that at the 4 permutation level, and then it jumps to 325. It's exponential. So, actually, it's not exponential, geometric. But what difference does it make? It's a lot of shit. How are you ever to determine when, if your decision has to be based on figuring out what permutation out of just 15 you've got to use to apply that, and you're trying to do that in real time? How are you going to do that? George Soros doesn't figure that out in real time. He's got everything already figured out. These are the economic conditions that I look at in the different countries, and they all coalesce into one feeling, one sense, not 52. You know, when the economic indicator news releases come out, they all tend to be in sync with each other. Otherwise, the economy is totally fucked up. You're not going to have new home sales and high employment and rising wages without increasing inflation. So all he needs to do is look at all those few 4 or 5 major indicators and go, inflation is increasing. The more the inflation, the better that is for the particular currency that you're at. Might not be as good for the economy of that country, but for people investing in the country, they're going to get a higher rate of return on that country's bonds and bills. So that's the conclusion that he comes to. So his rule is when inflation hits or grows at a 0.5% in a certain amount of period of time, my conclusion is this. But first of all, you have to know what is the main force that affects the particular currency that's there. And when you're dealing with just establishing a base for your particular learning, for your trading purposes, there's about 7 terms that you ought to be aware of, and the subterms are immaterial to that. There's only about 25 or 30 total terms altogether. That's easy. You know, when you're going to learn a computer programming language, there's only about 30 what they call reserved words in that language. There's a for command, there's a when command, there's a break command, just these basic commands that you put together. And if there's 30 commands, can you imagine what the permutation of those 30 commands could be? Well, it's infinite. You know, you have an octave of notes in music, and look at the tremendous diversity in music that we're able to produce from that by changing the scale. If you change the scale, then you have a multiplier of permutations that's involved. So the advice in believing you're at a point in your position where you can push all your money to the center of the table, it's certainly not possible when you're starting out in your trading. Let's say you're working at a job, you're making $30,000 a year, but from some wild reason, you've been able to amass $100,000 of money. So you've got $100,000 in your account. But your job is just not to go back to work at your job as a clerk, which pays you $30,000. You don't want to do that. So from your trading on a daily basis, you want to be able to cover that $30,000. And so how much do you have to trade of the $100,000? Maybe $50,000. So you get 60% return on your money. So you trade half of your account and you make $30,000 a year. You're covered. Now, when you get this opportunity to have price moving as what I call a runner, which is a price that runs beyond your profit target, you've got $50,000 left in your account to add 5 more lots or 8 more lots. It depends on the leverage that you're using, right? Into the position. And away you go. But if you try to make that 200 pips and going in on the one trade with your $20,000 account, and you're looking for 400 pips, you make $8,000. What's the likelihood that you won't have a retracement long before that that's great enough to have you get out? Because you don't know whether that retracement is a full swing. You don't know when you're trading off the daily chart when that swing is going to come or what the magnitude is. And that comes as a different result of order flow than the one that you used to get into the trade. So if your rules don't have, if your position management rules don't have a methodology for determining what to do under different circumstances of increasing price as a runner, you're going to be trying to work all those problems out in real time. And that's too much information to make a when determination from. So in the calmness of your life, if you're going to learn currency trading to be consistent and to replace your job income, which is the folks that I try to approach in my coursework, the fast track coursework, because it's done in 6 weeks. And we trade on a $1,000 bank, which allows you to trade one full lot of any currency that 5% isn't too much. I mean, right now, some of the majors that are trading from a U.S. standpoint require $600 of margin. So what are you going to do? Trade with $7,000 of capital? You're going to trade at 500 to 1? Oh, you can't develop any rules with a 500 to 1 trading strategy. You can't develop any metrics by staging in and out of trades and all that. You have to learn how to trade. And so you learn with $1,000 at $1 a pip. And the course, you have to read the whole course book up first a couple of times so you know everything that's in there, because it's simple. There's only about 10 things that you need to learn along with the 30 different terms. Oh, God. But the book alone isn't going to be enough for you. You have to have consulting. And that's why my course is me consulting against the course material manual. Because without that consulting, you couldn't ask questions in real time as you're reading through the coursework and as you're trading that $1,000 account to try to develop that when component. Underlying that whole course is developing a sense for eliminating useless information such that making the determination of a when rule becomes simple. And that's what you need to do. That's what is implicit within that course. By trading that $1,000 account, now you may lose $300 and then gain 200 and then lose whatever. And we just keep trading that $1,000 bank until you're able to define for yourself, not me telling you anything. You can't trade the way that I trade. I can't trade the way anybody else trades. You have to trade the way that you need to trade, but you have to trade it based on principles that make sense. The only other way to do that is to do it the way that most of these other guys that are talking about trading on the internet is they've lost 6, 8 accounts, substantial accounts. And I mean, you can have a lot of money and be a successful trader and lose a lot of money. But that's only because of an anomaly in the market, you could call it a black swan, or that you're just not going to believe, like you let a bad trade continue to run, and it gets to a point where emotionally you can't stand to pull the trigger because it's too much money, and so you go to margin call. Takes your account out. When you are looking at the solution set to you as a person, you can't be clouded with so much information. And so that fast track program eliminates all that stuff, and we focus on the life cycle of a currency position, starting out with what is trading. First of all, what's trading? How important are metrics and how are they used? How can we use those in real life around us so that you believe that the metrics that we're going to pick are going to satisfy your ability to establish consistent trading because of the metrics that you're able to maintain. And as you are trading and losing, you're learning what you did wrong based on violating the metrics that we set for you as a standard to try to achieve. So the first couple of weeks of that trading is you stumbling around as we work through the manual to get to the point where we're building those rules. And that gives you the experience that I'm trying to work with you on in order to see. I can tell you what the problem is, and I can tell you how to solve it. Anybody that's out there that you watch is telling you that information. And so when I put the when component in there for each little piece as we go along, maybe you don't notice that. But in the end, it will help you when we get to the actual building of the rules part to build those rules and for you to say, man, if I follow these rules, I have to be successful because the math behind the rule, and we have equations for each rule, is not hard, it's arithmetic. If the trading doesn't match what the results of the equations say, then I'm doing something wrong. And because we've got those metrics, we can point right to the metric that is failing, and therefore the skill that you're lacking in being able to do that. So that at the end of that 6-week period of time, you've been successfully trading that $1,000 account so that you are consistent. You understand when you're consistent, when you are matching a good set of metrics that you develop. And we're having you trade quite a bit, not exactly in the day trading spirit that we would normally trade at. You're trading under very, very rigid guidelines. It's like the difference between driving in a car and driving a train. If you're driving a train, there's only one way that train's going to go, and it's got to follow the track. You're locked onto the track. So we're on a train for that that first 2, 3, maybe 4 weeks that we're on to make sure that you are following those rigid rules. And then you're in a position to be able to say, okay, we're going to put you in a car. You drive the car the same way you drive the train, but now you have the flexibility. If you see this happening, you can sway a little bit over to the right. You see this happening, you can sway a little bit over to the left. You just have to stay between, instead of a railroad track that locks you on, you're now between the white line and the edge of the road. You see what I'm saying? And then you can start making your rule, not my rule. My rule is the railroad track, and it's just a mathematical rule. I don't trade that way, but that's how I teach the trading. Because if you're teaching somebody how to swim, you teach them a rhythm. You're doing the crawl. You do 2 strokes in a breath, and 2 strokes in a breath, and 2 strokes in the breath, and every time you stroke, you're doing 2 kicks or whatever it is that you're doing. It's very regimented. But when you're actually in the pool in a race, you may not breathe for 4 strokes. You may kick 5 times. But that's up to you. Now you're using your intuitiveness to go into trading. The Forex market is trading. The Forex market, you cannot do it by intuition. Intuition is, oh, I feel. Because as soon as you say, I feel, I think, you're screwed. You're screwed. Oh, I think the price should go to here. Really? What probabilistic evidence that you have done would point to that? If you don't have that, then you're not going to be successful. If you try to fade that rule, you're not going to be successful. And so it takes about 4 weeks, maybe less, but 4 weeks. That gives us 2 weeks to back down on the numbers of times that we trade, to look for the the real solution to the problem that you have identified for your own entry rule and your own position management rule and your own exit methodology rule. So that in that last couple of weeks, or maybe we'll go over, I'm just not running a, like I'm running a taxi cab meter or something, an Uber meter on you. And then, that's the end of the course. I don't work with many people, so I can work with you to the extent where you need that help. If you need more help than would be normally expected because you're struggling with a particular instance, you can sign up for additional consulting work. You don't have to take advanced solutions course or anything like that. You can just sign up for some consulting, and we'll continue on with working with you, because it doesn't take long. I mean, it's not 10 hours or anything. Maybe 2 hours or 3 hours more you need in order to help convince you that you need to stay. These are your rules. You're not following those rules. So there's no amount of further consulting that I'm going to be able to do. I'm pointing to the rule that you're breaking, and I'm showing you in the rule where the condition is that would prevent you from doing that, and that's what you're doing wrong. You're simply not adhering to that condition. So that becomes your choice. And if I see that you're going to continue to break that condition and fail, then that's on you. It's not on me. And there's no point in charging you more money for consulting, because if you know what you need to fix. It's like if you're driving your car and you're drinking and you keep running off the road, and somebody comes and says, do you want to run off the road? And you go, no. Well, then you have to stop drinking and driving. If you continue to drink and drive, I'm out. Nothing more I can do for you. That's your choice. And that's why it's important in the beginning of the course that we work together to make sure you understand the importance and the validity of these metrics that we're going to be developing out of your own trading. Based on, here's the metric goals that we have for you by the end of the 6-week period of the course. So when you get to the end of the course and you're achieving those metrics or those guidelines, and sometimes we're talking about P&L, sometimes we're talking about the metrics or whatever, but it's a correlation of about 6 different things that we look at. Consistency is the hallmark of all of it. So if you're consistent over 10 or 20 trades, which is, a couple of trades a day is well within the bounds of day trading. You go to scalping when you're hitting, probably over 6 or 10 trades a day. Then you're kind of scalping the market, or you're trading all day long. And you're still day trading because you're flat at the end of the day. My course, a lot of truck traffic because there's a house being built down the road from us. I live up on a mountain in the Lakes region of New Hampshire, and it's kind of remote. There's not many people in the town I live in, and we're up on a mountain. And so when somebody's building a house, the traffic is pretty busy. Here comes another huge dump truck down the road. So they're all they're all showing up to work because it's 8:30 in the morning. When we're looking at that $1,000 account that you're doing during that 6-week trading period, and you are successful at trading consistently over 10 or 20 trades, it doesn't take very many trades to say, oh yeah, I got this, because you got it. If you can be consistent, that doesn't mean you're not losing. It just means that you're consistently, your loss is within a certain boundary range and your gain is within a certain boundary range. The median gain is within a certain boundary range. Your loss is locked. We take care of that right away. You never have to worry about loss. Because the last thing you want to do when you're trading in real time is try to figure out what your risk management should be. I just can't. Oh, man. It's so simple, guys. It really is that simple. And when we get to the end of that fast track course, right before we check out, then you go to a $10,000 bank and you trade one full lot at $10 a pip. And if you lose a lot of money in that and you go out of boundaries of where your consistency has been, then I'm going to say you're emotionally not geared up right to make that jump to the one full lot load. Because now you trade 3 pips and you've lost a pizza, a specialty pizza. You don't want to be losing too many pizzas in your trading. So what are you doing wrong? Let's work on that so that, because if you can do it in a $1,000 account, you can do it in a $10,000 account. And you can do it in a $100,000 account. So the fast track program is geared to take you through that first maybe week of trading that $10,000 account. If you don't have $10,000 at the time, that's fine. Continue to trade the single mini account, or trade or trade 5 minis, or whatever you want to do. I'm not an advocate of trading. You trade 1 mini to learn, but if you're going to trade, you ought to have $20,000, $30,000 capable trading bank, because you're not going to affect your lifestyle on a $10,000 account unless you're trading at 500 to 1. And if you're trading at 500 to 1, you're going to win, you're going to win, you're going to win, you're going to think you're a hero, and then you're going to lose all that money and your original $10,000 or whatever it is that you have. That's just the way that it is. If you have 8 years of experience and you've been trading at 500 to 1 and you're not worried about all this stuff, but you're consistently trading and you don't mind losing $20,000 or $30,000 because you got another $400,000 or $500,000 behind you, it's no problem. You continue to trade. I'm not saying trading at 500 to 1 is you don't ever do it. There's a time when you do want to up your leverage, and when you can and when you should, but that's the next step in your risk management, not where you start from. These fools are getting you to trade 100 to 1 leverage from day one. They're teaching at 100 to 1 leverage. They're teaching at 500 to 1 leverage. That's crazy. If I'm teaching somebody real estate, I did real estate for 40 years. I wouldn't teach them to get 100% financing. You got to have some skin in the game. A lot of skin. And these people that are going in with 5% down, it's a disaster. If you can't afford to come up with more down payment, then you certainly can't afford the payments that are going to go on 5% down mortgage. So if you're trading currencies to replace your job, which is what I'm teaching people to do, how to gain the skills so that they can replace their job income, but not on a $10,000 or $20,000 account. You can't. You can start significantly impacting the replacement of your job income at 10 to 1 leverage, reasonable leverage, on a $30,000 account. Even if you only made 20% against your account, you'd be making $6,000 a year. So if you're making $60,000 a year and you could make $6,000 on a $30,000 account, is your boss going to give you $6,000 as a raise? Are they going to give you $6,000 as a bonus? Are they going to do that every year? But you've got this thing in the background kicking out $6,000 for you. And as you grow that account, it goes from $30,000 to $40,000 to $50,000. At $60,000, you're still making 20% against a $60,000 account. That's $12,000 a year, and you're making $60,000. How you doing? You're doing really good. But by that time, why wouldn't you be able to get 40%? I mean, if you're not making 20% on your currency trading against your risk, then you shouldn't be currency trading. You can make 20% on real estate. You get 5 to 8% a year appreciation on the property, depending on what part of the country you're in. But then you've got net cash flow out of that. So you're making 25% return on your money, 30% return. If you can't make that in currencies, which is a little bit more risky, a lot more risky than real estate, every time you go up in risk, you have to go up in a reward to balance that extra risk that you're taking. If you want to do no load index fund or whatever, you can get 8% on your money over a 20-year period of time. If you want to get 20% compounded over time or 25%, you go into real estate, but that's more risky than the index fund, right? Or if you're going to go into currency trading, that's more risky than the real estate. Real estate could take you months and months to lose your money. I know that for a fact. In my 40-year career as investing in real estate, I lost my $1 million net worth twice. And it took me 10 years each time to make that $1 million back, so that I was able to retire at the end of the thing. Because I saw the cycles coming, I said, I'm not going to take the risk because I'm ready to retire. I was 68. I'm going to quit. I'm going to sell off my real estate portfolio. So I sold it off, and over $1 million net worth. And here I am, because I wasn't willing to take a 4-year or a 3-year downturn in real estate. Now, as it turned out, the real estate continued to go up, and I could have made probably another $300,000 or $400,000. But correspondingly, when the break comes, and it's certain to come because prices are too high, you won't be able to get out, and then you lose it all, like I did. I wasn't willing to do that. So currency trading is riskier than that because of the fact that you can lose your whole account in one trade, just like that, in one day, if you don't have good risk management. That's just the thing of it. So do you think that it's worth trading if you can only get 20% on your money? I've got the math to show you how to get 130% on your money. Are you going to be able to do that? Yes. But here's the different parameters that you need to have. And you need to have an emotional component. When you get to that point, you need to have a good emotional component, and your psychology has to be on balance. In the beginning, when you're trading, maybe $30,000 account or something like that, those components aren't that important to you because you're not replacing your job income and trying to live off that money. Your trading is building and building and learning and growing. So if you get your psychological makeup under control, then making 20% is pretty simple. And the math shows you, well, if I make this one little tweak to the equation, I could go to 40% or 60% against my risk. The question is, are you able to make that change? And the more money that you have, the more difficult some of those changes are to make, because they are based on your psychology and your maturity as a person, until you get so much money that you've got, maybe $500,000 account, $800,000 account, and you're just happily trading $200,000 or $300,000 of that and making 60%, making what more do you need? $180,000 a year. Just take it off, and you've got the whole rest of the money there. That when a big opportunity comes, you go, and now maybe you have a $20,000 day, or a 30 or 40% month. I've had months where I've made 20%, 21, 23%. I think I've had several months where I've done that on a 6-figure account. Not $100,000, it's more than that, but yeah, I've made 6 figures trading. So I had a lot of base money behind me. So I'm just following the math. Now, I've lost a lot because I'll get the when component wrong when I push the stuff to the center of the table. And then all shit goes apart, because I'm go to my real estate animal brain. Don't sell the real estate, it'll come back. Well, currency prices don't come back. But that's my problem. And so, I'll lose a lot of money, but I generally come back with a solid percent against that bank that makes it, somebody else's yearly income. I'm left with, after I've had 2 or 3 times that amount of money based. And then there was the one time where I got the when totally wrong. I got totally screwed up. I was in a bad situation and I lost my 80%. I was going into the fourth quarter of the year. I lost 80%. I was up 80% on my bank going into the fourth quarter. I lost that 80%, and then I lost another big 6 figures, and I went, whoa, wait a minute. What am I doing here? I'm trying to make $1 million like I did in real estate, but I'm too fast and I don't have a large enough bank in order to do that safely. And now I really don't have a large enough bank to do that. Let's just reevaluate what you're doing here. You're a millionaire. You're 75 years old. You don't need to make $1 million. I was just doing that as an exercise, and that cost me a lot of money. So I'm saying, hey, let's cut back on the size of the account so that the money that I'm making, somebody can look at me, my students can look at me and say, well, if he can do that by following these rules, which I've developed along with it, then I can do that too. Instead of, somebody who's getting started in that, for that $10,000, 20%. Let's set that as a goal. Let's just at least beat the real estate. So I'm trying to make a couple of $1,000s a year on that $10,000. Well, it doesn't mean that you have to trade for a year to make $2,000. Your metrics and your P&L along the way will say, oh, I'm on track to make $2,000 a year. I'm making $200 a month. I'm making $50 a week. I'm doing okay. And at that point, you can say, okay, well, how do I up that? How do I take that next step? And do I have the confidence then to go to a $20,000, go to a $30,000 account? And most folks that are trading, for example, in the stock market, you have to have at least $25,000 to trade stocks. Because if you trade more than 4 times a week or something like that, you're called a pattern day trader, and you must have $25,000 in your account, or you're not going to trade. So most of the traders that are out there have that kind of money that they can significantly impact their incomes. Why not do that in currencies and say, well, I worked here. I know I can get 20% on my money safely, so I'd be willing to put my bet on the line in currencies with my $30,000 and trade that in currencies and make 20% against that, and be happy with that $6,000 a year, and then increase that skill so that you're picking up the 40% or the 60%, or maybe even a 10-to-1 leverage. The equation says that you can go to 120% on your money at 10% leverage. Think of what you could do when you learn how to actually correctly implement compounding and staging, and a little bit more leverage. It becomes whatever you need it to be. You see some of these guys that get beat up really, really bad, and they become successful. They've got 6-figure accounts, and they really know how to trade. But they don't know how to teach you, because they start teaching you Bollinger Bands and indicator-based systems. They really don't know how to teach because they didn't learn along the way. They learned what not to do, but it wasn't from a pre-planned effort to make a mistake and learn what not to do and then build a rule that won't let you do that. There wasn't any of that. It was just going in and throwing money. I mean, just talk to these guys. That's how they learned. Some of them are know how to do that. They're good enough that they can teach it. I approached it when I was trading. When I funded my first large account. It was $45,000. I lost, and that was after 7 years of study and simulated trading in a demo account and a couple of live mini accounts and writing computer applications against that. I go in with $45,000. I lost $40,000 in 3 or 4 months. And that's when I stepped back from it and said, well, wait a minute. All that education that I had out there and everything that I thought was about trading, it's not true. It's too complicated. I was doing too complicated stuff and over-leveraged, like some of these guys are talking about. I backed up, and that's when I wrote the life cycle of a currency position back in 2018 or whatever it is. And I haven't changed those rules. And right after I wrote those rules, I took my remaining $5,000 and doubled that in about 4 months, 4.5 months. I was within $200 of doubling it within about 4.5 months. And I said, oh, I got this. I added $10,000 more to the account. I traded that for a little bit and didn't go broke. I added $50,000 more and traded that account and didn't go broke. And away we went. So when you have a learning process like that, not just constantly dumping your account, coming back in and reloading, and dumping your account and coming back in and reloading, you don't learn anything that way. That is teachable. You learn what not to do, but you don't learn how you would teach it, what the incremental steps are. And that's the problem that the Fast Track program overcomes, is learning what not to do and learning why you shouldn't do it. Not just not what to do, but why not to do it. In any event, when you know you're right, no bet is too big. It's the when component that you need to be aware of that's really the secret sauce of success in trading the Forex market. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.